Welcome back, dear students and scholars. In the first ASC 405 lesson, we focused on liability settlement and derecognition. Now we move beyond basic extinguishment into three practical areas: insurance related assessments, joint and several liabilities, and supplier finance programs. The main question today is simple: when do we record? How much do we measure? What do we disclose? And who must support the conclusion before the close is approved? This roadmap shows why ASC 405 Video 2 must be handled carefully. ASC 405 30 deals with insurance related assessments where probability, an obligating event, and a reasonable estimate matter. ASC 405 40 deals with joint and several liabilities where we measure the agreed share plus any expected extra payment. ASC 405 50 deals with supplier finance programs, which are mainly about buyer disclosures. Same ASC topic, but very different accounting jobs, so please do not mix the models. Think of these three zones as three different accounting rooms. In the first room, the question is whether an insurance assessment is probable and estimable. In the second room, the question is what amount the reporting entity must recognize for a shared fixed obligation. In the third room, the question is what the buyer must disclose about supplier finance programs. If we take a rule from one room and apply it in another, the accounting gets confused very quickly. Accounting standards do not enjoy room swapping. ASC 405 30 applies to entities subject to guarantee fund assessments and other insurance related assessments. The first question is always which statute or regulator creates the obligation. Examples include state guarantee fund assessments when a licensed insurer becomes insolvent, workers' compensation second injury fund assessments, assessments based on underwriting activity, and regulatory mechanisms affecting self insured entities. The key point is that the obligation usually does not come from ordinary management preference. It comes from a statute, regulator, or legally enforceable assessment mechanism. Before applying the recognition criteria, we must check exclusions. Reinsurance contracts or arrangements, certain involuntary pools under insurance guidance, depository institution insurance assessments, the ACA health insurer annual fee, income taxes, and premium taxes are not handled under this ASC 405 30 model. That means the first control is scope. If the item is excluded, it must be routed elsewhere. Wrong scope creates wrong timing, and wrong timing can damage both the balance sheet and the income statement. For an insurance related assessment liability, three gates must align at the reporting date. First, the assessment must be probable before the financial statements are issued or available to be issued. Second, the obligating event must have occurred on or before the reporting date. Third, the amount must be reasonably estimable using available rate and base information. If even one gate fails, recognition is not ready. A probable assessment that cannot be reasonably estimated may need disclosure, but it should not be forced into an accrual. Different assessments have different probability triggers, and this is a classic exam trap. For a non pre-funded premium guarantee fund, probability may be tied to the formal insolvency determination by the regulator. For a pre-funded guarantee or administrative assessment, the trigger may follow related premiums written. For a loss-based administrative or second injury fund, the trigger follows the related losses incurred. Do not use one trigger for every assessment. The trigger determines the reporting period, and the reporting period determines whether the liability belongs in this clause. Now let us apply the model to Harbor Mutual. Covered premiums written during 2026 are $80 million. A state regulator formally declares an insurer insolvent on December 20th, 2026, which is before the December 31st reporting date. The expected assessment rate is 0.35%, and management can estimate the amount before financial statement issuance. All three recognition gates are satisfied: probable assessment, obligating event before year end, and reasonable estimate. Recognition is required at December 31st, 2026. The calculation is $80 million multiplied by 0.35%, which equals $280,000. The journal entry is debit assessment expense for $280,000 and credit assessment payable for $280,000. The income statement recognizes the assessment expense in 2026. The balance sheet presents the assessment payable as a liability at year end. There is no cash flow effect on the accrual date. Cash changes later when the assessment is paid to the fund. The assessment close process needs evidence before accrual. A regulatory signal starts the analysis, but finance still needs legal confirmation, premium validation, rate support, and journal review. Legal and compliance confirm the regulatory action and statutory obligation. Actuarial and finance validate the premium or loss base and rate estimate. Tax and risk review cross topic issues and premium tax coordination. Controllership reviews the entry, approves the disclosure language, and signs off. This is how an accrual becomes a defensible accounting conclusion, not just a spreadsheet number. Now we move to ASC 405-40, which covers joint and several obligations. This model applies when two or more parties are jointly and severally liable and the total obligation is fixed at the reporting date. Examples include co-borrower debt arrangements, settled litigation, fixed contractual obligations, and judicial rulings involving multiple liable parties. But do not apply this model when a more specific topic controls, such as ASC 410, ASC 450, ASC 460, ASC 715, or ASC 740. The fixed total requirement is the gate before measurement. If the total obligation of the reporting entity and the co-obligors is fixed at the reporting date, then ASC 405-40 measurement can proceed. The reporting entity may still be uncertain about how much it will ultimately pay for co-obligors, but that uncertainty is handled in measurement, not scope. If the total is not fixed or determinable, then we do not use ASC 405-40. We route to another applicable ASC topic, often contingencies or another specific obligation model. The measurement formula has two components. Component 1 is the agreed amount the reporting entity is responsible for under the arrangement. Component 2 is the additional amount the entity expects to pay on behalf of co-obligors who cannot or will not pay their share. The recognized liability equals the agreed share plus the expected extra payment. It is not automatically the full joint obligation. Recording the full legal maximum without evaluating co-obligor creditworthiness can overstate the liability. Joint and several does not mean journal entry for everything every time. Let us apply the formula to Vega Labs. The total fixed settlement is $1 million. Vega Labs agreed to pay 60%, so its agreed share is $600,000. The company also expects to pay $150,000 because of a co-obligor shortfall. The recognized liability is $600,000 plus $150,000, which equals $750,000. Vega does not record the full $1 million because the remaining $250,000 is expected to be paid by the solvent co-obligor. The journal entry for Vega Labs is debit litigation settlement expense for $750,000 and credit joint and several liability for $750,000. The credit is the shared obligation measured under the standard. The debit depends on the underlying transaction. If the obligation comes from litigation, it may be settlement expense. If it relates to acquiring or constructing an asset, it may be asset cost. If another transaction created the obligation, a different debit account may be appropriate. Facts drive the debit. After recognition, the reporting entity must handle presentation and disclosure. The measured liability of $750,000 is classified as current or non current based on expected settlement timing. It should not be netted against a receivable from co-obligors unless offset criteria are met. The footnote should describe the arrangement, the parties involved, and any material uncertainty around co-obligor payment risk. The controller should challenge both the agreed share and the expected extra payment each close because co-obligor creditworthiness can change. Now we move to ASC 405-50. Supplier finance programs are disclosure focused. This subtopic gives buyer disclosure guidance for programs used to purchase goods or services, but it does not create a new recognition or measurement model. The purpose is transparency. Financial statement users need to understand the nature of the program, the activity during the period, and the potential magnitude of outstanding confirmed obligations. In plain English, this standard is saying do not hide liquidity pressure inside ordinary looking accounts payable. To identify a supplier finance program, look for three main signals. First, the buyer has an agreement with the finance provider or intermediary. Second, the buyer confirms supplier invoices as valid and payable. Third, the supplier may request early payment from the finance provider or another party, often at a discount. A fourth signal may also appear when the buyer commits to pay the finance provider for confirmed invoices without offsets or defenses. These signals show that normal trade payable activity may have a financing structure behind it. Not every buyer, supplier, and bank arrangement is a supplier finance program. Standard corporate credit card or purchasing card arrangements are excluded. Payment processing arrangements are not enough by themselves. Normal factoring initiated by the supplier, where the buyer has no confirmation role, is also outside the model. An ASC 405-50 is a buyer disclosure model only. It does not govern the suppliers or finance providers' accounting. The practical test is does the buyer confirm invoices and can the supplier choose early payment from a third party? The qualitative disclosure explains the program to users. It should describe the arrangement, the parties involved, the payment terms, the invoice confirmation process, any fees or platform costs, termination provisions, and balance sheet presentation. For example, if the buyer confirms invoices and suppliers can elect early payment from a finance provider, users need to know whether confirmed obligations are still classified as accounts payable and what amount is outstanding at period end. The goal is not to write a long note. The goal is to make liquidity effects understandable. The quantitative roll forward shows activity clearly. Here, beginning confirmed obligations are $4,800,000. Invoices confirmed during 2026 are $37,200,000. Confirmed invoices paid are $35,900,000. Ending confirmed obligations are $6,100,000. The increase is $1,300,000 because 4.8 million plus 37.2 million minus 35.9 million equals 6.1 million. Analysts use this roll forward to see whether accounts payable includes program related financing effects. Supplier finance controls must reach across departments. procurement documents, program terms, supplier enrollment, and confirmation protocols. Accounts payable validates the confirmed invoice population and the period end balance. Treasury confirms the finance provider agreement and buyer payment commitments. Legal reviews payment obligations and termination language. The controller reviews the disclosure, challenges the completeness of the program population, and approves the final note. Recognition may not change, but disclosure completeness absolutely matters. A program that is invisible in the notes can distort a reader's liquidity analysis. Let us recap the four takeaways. Insurance related assessments require probability, an obligating event on or before the reporting date, and a reasonable estimate all at the same time. Joint and several liability equals agreed share plus expected extra payment for co-obligors, not automatically the full legal amount. Supplier finance programs are primarily buyer disclosure models under ASC 405 50, and close controls protect both recognition quality and disclosure completeness. In the next ASC 405 video, we move into practice cases, journal entries, IFRS bridge, SAP bridge, and targeted exam traps. If this lesson helped you, please like the video, subscribe to the channel, support the course, and share it with colleagues learning US GAAP.